Good morning, traders. It's Monday, 19th February 2018. Another week, another time for real-time daily trading ideas. We have 5 days a week, 5 different traders. We will speak about trading ideas, strategies, market screening, and maybe 1 or 2 questions from your side directly answered in our webinar. Our goal is quick and smart, but for that daily, so let's have a nice start like every day. Of course, we will start with our risk disclaimer. Forex and CFD trading is leveraged trading and can result in losses that exceed your deposits. If you are a starter, please start with a demo account and make yourself familiar with leverage trading and your personal risk management. If you'd like to read the full disclaimer, just visit one of our web pages, for example, admiralmarkets.com. This is me. My name is Jens. My English is made in Germany, but hopefully my quality too. But I'm not the main speaker. The main speaker is one of our day traders. This is our scheme. On Monday, like today, is Jay's day. On Tuesday, it's Paul's day. On Wednesday, it's Mike's day. On Thursday, it's Nenad's day. And on Friday, it's DX day. Our leading day traders live. Today's actions are tomorrow results. Yeah, and of course, we would be happy if you like to trade Forex and CFDs if you do it with Admiral Markets. Many benefits you only get with us. For example, one of our bestsellers, the DAX 30 CFD. With a typically fixed spread of 0.8 points in the main trading hours, you can start with 0.1 lots already, mini lots, and of course a choose of leverage and a negative balance protection policy as our safeguard. Check out all the benefits and all the details, of course, at admiralmarkets.com. There you will find also something about our regulatory background. Admiral Markets UK Ltd is authorized and regulated by the Financial Conduct Authority. And of course, if you want to contact us by phone, by email, or the other channels like YouTube or Facebook, everything is linked from admiralmarkets.com, your webpage you should visit if you like to trade Forex and CFDs. That's enough from my side. And now it's time for Jay. Hi, good morning, Jay. What's the market today? Let's have a nice start. But I get an information. We have a technical problem. For any reason, Jay was online. Now he's offline. I guess we have to wait a couple of seconds or 1 minute. Give me a short break. I try to contact Jay via phone. So for any reason, we have a small technical problem, but Jay will try to log off and log on again. Usually that helps, so give us a couple of seconds and hopefully then the technique will run.
Danke dir.
So, technical problems are solved. Sorry for that. And now it's time for Jay.
Good morning, traders. Let me show you my screen. And please, Dees, maybe you can let me know if you guys can hear me. Juan, can you hear me?
Everything runs. We can see your screen.
Okay, so you can see my screen and you can hear me. All right, Rafael, thank you very much. Good morning, traders. All right, let's roll. I don't know what happened here this morning, but hey, IT is not liking me this morning. Let's go. Quick update on the big picture scenario, which I thought, given the V-shaped rebound, might be some value add for us. Okay, what are we seeing? Big picture futures, S&P 500, bouncing off at a high volume node and coming back into never land. So now it's decision time. Unfortunately, today is a US banking holiday. So lucky for these guys, they're off into the Hamptons and we're sitting here and we're going to look for direction in a market that is lacking liquidity. On top of it, we have Lunar New Year in China. So we're adding the 2 largest, we're lacking the 2 largest economies in the world to give us some direction. But nevertheless, let's have a view on the big picture. We see that the dollar index has been coming off. This is a daily picture. If you may recall, the DXY is the dollar versus 6 other foreign currencies out of the G8, and 60% of the dollar index is versus the euro. So if you overlay a euro dollar chart, you see a very high correlation here. There's some chart marks here at 88.5 where we bounced 3 times. 90.40 is a significant role reversal, and then 91 big figure, also option expiries there. So we'll have to wait and see. Again, here we're sort of directionless right now. ETF flows may be of interest to some of you. We're seeing Africa's is very bullish, metals and mining. Unfortunately, it's in German, but there was a pretty good speech or seminar that I gave, an hour and a half long, on the business cycle and on the interest rate curves and which sectors within a business cycle perform. And late cycle, we always have metals and mining performing very bullish. So this is an indication that US may be late cycle. And let me give you a side note. It's very, very odd, very odd for the administration to be coming out with the tax package now and an infrastructure spending program that, by the way, currently has 0% of passing in the House versus the Democrats and in Congress. But nevertheless, it's very odd to come out with government spending this late in a cycle. Would have been much better to do this at the end towards a recession. So the probability of a US recession is increasing over the next 2 years. That's nothing new, that's expected late cycle. We need to keep an eye on the curves, on which sectors are performing. And on top of it, we'll also need to see if the equities are turning into a leading indicator and giving us an indication that we're heading towards troubles. Right now, PMIs are still positive. We have lots of PMIs coming out this week. We'll have a look at that in a second. So the economic backdrop is positive. UBS did a survey on high net worth individuals, 1,000 of them globally. And what was very positive there is that their extreme bullishness came off a little bit. So the counter indicator of retail traders and high net worth individuals being extremely bullish is coming off a little bit. So that's good. Also interesting to notice here that the short developed world and short emerging markets is bearish. So that is also an indication of ETF flows going back, passive money going back into the long equity trade, and long volatility is in accumulation mode. That's a little worrisome because the current expectation of the market is that that volatility explosion has been somewhat unwound, but there may be a bit more to do in what we call the gamma books. It's a little deep right now, so let's just carry on. Rates, volatility, equities. What are we seeing? We're seeing a short end at 219. That is US 2-year yields at 219. We're seeing US 10 years coming from 240 all the way to 290, currently 288. That was one of the reasons why we started coming off in equities, is that the dividend yield and the risk-free 10-year treasury yield are starting to approach each other. And that means that what we call asset rotation, it's not happening yet, but at 290 or 3%, it becomes a viable option for some long-term money to switch from more volatile and risky equities into the supposedly less volatile and less risky 10-year treasuries. Okay, and the 30-year at 313. What we see in the US is that mortgage rates are increasing, and we expect that for any economy where the rate environment is rising, and the rates are rising because we see an increase in inflation expectations. And we actually see an increase in US debt, and that needs to be refunded. That tax deal is actually demanding another 1.2 trillion US dollars to get funded. That's quite a lot, and that's obviously where we see the rates parallel shift higher. Volatility, you can see this light blue line spiked higher, came off. That is the question right now, around 20, where we are in no man's land. My expectation is that vol below 10 may not be the new normal. It's probably that volatility, or there is some probability and some expectation on my side that volatility is is finding a new normal a little bit higher, but that is a way to be seen. 530s is very important. The 530s has been steepening and now flattening again, but again, today holiday, so not that good of an indication, but this is the big picture that we're going to keep a closer eye on before we start. Here you can see the VIX on a daily. We went all the way above 50 and now we're around 20, slightly inside of 20. And here's that low volatility regime where we had prior to May 17 less than 10 days of volatility inside of 10, and after May 17 we had over 60 days of volatility inside of 10. Basically, that means in layman's terms, we had everyone long equity and their grandmother, and we had everyone and their grandmother shorting volatility, including retail traders via passive ETFs, and that trade exploded here, and now it's coming off. So interesting times. Trade from last week, we had a short euro dollar. That was a clear loss. We had data, better than expected CPI headlines that caused the dollar to rally. And then we had much worse retail sales, and the US consumer makes up 70% of the economy, super, super expensive, and then the dollar came off again. So let's take a look at the chart. We had these liquidity levels drawn in, and what happened is that the first liquidity level, and I want to explain this to you guys, the first level saw a reaction, but that was bought. That's not a bearish signal, not at all. Then, as soon as we approached the next liquidity, we had what we call a right hand up hold. We held, we bought that liquidity, went to the second liquidity that was bought again. Then we had a reaccumulation. Then we hit the next liquidity level up here, and this is at the 125 plus a few pips, is where we actually had a macro bounce, and we were rejected once again around the 125. Here you can see CPI much better than expected. This is where the euro came off and the dollar strengthened, and then a few minutes later retail sales much worse, and that caused dollar weakness and the euro dollar to climb even higher. So difficult for me and for any trader to give on a Monday morning a trade for the rest of the week. It's not an excuse, that's the reality. It's much easier if you wait for Monday, which I term the construction day. We watch the big boys getting into position for their place during the week, and on Friday, the square up day, where all the swing traders and day traders take positions because they go flat into the weekend. So this is the square up on Friday where profit was taken, and now we see a reaccumulation long in the euro dollar. Picture this morning in terms of flows, we had a risk on environment. We can see this, that the yen saw finally some outflows and the Swiss franc saw some outflows in the overnight session. And we had Canadian dollar, US dollar, Aussie dollar all seeing some inflows. This is what we term a risk on environment. We have some important risk events this week. Unfortunately, not that many catalysts. So it could be a week for all you technical traders to make some money. It is also dependent on what some of the central bank speakers will actually voice. We have quite a few of them hitting the mic this week. So these headlines, as I call them, can actually move markets intraday, which may be good opportunities for you day traders. In terms of the pound, we have average earnings index. Unfortunately, not a big deviation expected. We have the FOMC meeting minutes, the ECB meeting minutes, the Australian meeting minutes. Then we have Canadian dollar CPI. Let's get into the numbers real quick. My computer is slow. Give me a second. What do we expect in terms of the US? As I said, meeting minutes and flash manufacturing PMI expected above 50. So macro backdrop in terms of an economics is still positive. Services the same, positive. The Fed, this is important, changed the wording in regards to inflation. They actually removed remain somewhat below 2% in the near term. Now think about this logically. If they say, hey, we remove the words inflation remains somewhat below 2% in the near term, that actually signals to you, the trader, hey guys, inflation could actually rise higher. And they added the word further as they talked about their rate hikes. They said further gradual increases may be or will be necessary. And that leaves the door open to them for potentially some more aggressive rate hikes. And we saw that immediately the futures market started pricing in a higher probability, currently pricing at 83.1%, that they're going to hike rates in March. Now, remember that DXY chart with the dollar so weak? Okay, currency chases yield. So this is an anomaly. This is not normal that the dollar is unwinding. This is purely due to extreme positioning in terms of being long dollar, whereas the yields are rising and the currency is weakening. And the market has assigned a 64% probability for 3 hikes. And last week we saw that at 54, and 4 hikes is slowly creeping up 27% right now. So this is all dependent on inflation. So guys, every time you see a CPI number, please be focused on this. This is the name of the game right now. Friday, we have the first monetary policy report, unfortunately, without a presser. Presser is a press conference by our new Fed chair, Mr. Powell. The first time he's testifying in front of Congress will be on February 28. So the market is expecting him to continue Yellen's Fed's policies of gradually normalizing rates. Here again, inflation and wage growth data will be their focus. And we have ahead of the March meeting, we have one more set of labor data that may or may not confirm or deny that strength that we saw in wage pressures from the January labor data set. Focus will be on his assessment of recent market volatility. Last week, Powell hit the mic and he said, we're keeping an eye on that volatility. But remember that another Fed speaker 2 weeks ago said, this is all, what did he say, peanuts or small potatoes? He said volatility or this 10% correction is small potatoes. Yeah, we talked about that last week. Euro, we also have the ECB monetary policy meeting. And here the problem with the ECB is that the market is waiting for them to tell us what's happening after September with your asset purchasing program. And the market is waiting for timing on their guidance. So dear ECB, when will you tell us you're going to change your language or your wording? Currently, they're not telling us that. And the market is expecting the March meeting to yield us a little bit more clarity on the path forward for the ECB. Additional focus in this meeting account will be on that FX volatility and euro rate strength. And the investment bank research teams are battling each other right now, where some saying euro rate strength is important to the ECB, and others are stating, no, the economic backdrop is so strong and corporations are well funded that the euro strength is not playing too significantly into the monetary policy of the ECB. Off we go, if my computer would play along to the next slide. Interesting. Hello, thank you very much. Let's see.
Now we know most of the technical issues today, your computer.
Yeah, unbelievable. So pound average earnings index, as alluded to earlier on, not much pressure expected to be feeding into the data yet. And inflation report hearing. This strong labor market, that will be either how can I say that? They will either cause the hawks within the committee to win majority and put May on the table for a rate hike. And of course, if it is a weak labor market situation, then rate hike expectations will move towards August. But please, guys, remember, last BOE statement was super hawkish. So fundamentally, you would rather want to be long pound. And if there's a risk on environment, you want to be long pound versus, for example, yen, and then you would look for bottom edges to buy them, okay? So during this inflation report, comments will be focused on if May is on the table or not. Aussie dollar, real quick, Tuesday, again, same thing, policy meeting minutes, and Wednesday we have, if the computer will show the slide, thank you, wage price index. It's the same story in the developed world everywhere. Yeah, it looks like inflation is coming, but in most developed economies, wage pressures are still not there. And here you can see it as well, not 5 versus not 5. So will there potentially be an increase in inflationary pressures? Yes or no? Last speech by RBA Governor Lowe was, hey guys, market, forget it, we're not hiking rates. And that was a surprise because the market was still positioned for near-term rate hike expectations, and that caused Aussie dollar weakness. He said, hey, our timing will depend on the extent and the pace of progress that we make in reducing the unemployment rate. So, RBA mandate, unemployment rate, and having inflation return to target. And most inflation targets for the developed world are at 2%. Yen, same thing. Flash manufacturing PMI this week, also expected to come in strong. And so we still have a coordinated global economic growth scenario in place. And then Friday with the national core CPI. That's expected to come in unchanged, really. CPI ex fresh food and energy seen steady at 0.3. And then for December, this is a statistical outlier. We have higher expectations for fresh food prices. So please don't trade this. This is already priced in. If you see this, don't react and hit the button long yen. It's already priced in. BOJ will focus on the core CPI data. This is really keen to them. And here's the great scenario. Abe, monetary policy, Kuroda was reassigned for another 5-year term. This is the head of the Bank of Japan. So for the next 5 years, we know we're printing money. And he has 2 deputies. One guy is new. He's an economic professor. And this guy is a bold advocate of printing money. So the yen is expected to weaken. Anytime you see risk on, be happy you can reuse the yen as a funding currency for your swing trades. Kiwi Monday GDT price index, as you may recall, milk is a very large influential factor for the New Zealand economy. So we're always watching the GDT Global Dairy Trade Price Index. And last time was 5.9%. And if you look at the graph, which we're not going to right now, it is increasing. So milk is getting a little bit more expensive. Milk, retail product, getting more expensive. That is a good example for inflation. And then we have retail sales. Everywhere in the developed world, the retail consumer is very important. And here we see a QQ increase expectation on core, course, X autos and X gas stations. So Kiwi, you want to be long. Last week, we had some higher 2-year inflation expectations in the Kiwi. So fundamentally, you want to be long. If you look at the Kiwi versus US dollar, we are at a daily top edge. So wait for it to come off and then watch for reaccumulation into a long, potentially. All right. Positioning data, if my computer plays along, thank you, computer. Commitment of traders didn't show us any extreme positioning. In the Canadian dollar, we're coming off of our short positioning a little bit, so no signals there. Volatility is coming off a little bit, just like the VIX. You can see in the euro, we're coming off. In the pound, we're coming off a little bit. In the yen, a little bit. And the VIX below 20. That was a good trade, by the way. 50 down to 20. Selling vol. Wow. Option pricing, dollar yen long for Monday, although the guys are off. I am long dollar yen, just to let you know. Aussie dollar long for Monday and gold long for Monday. This is interesting because dollar yen is a risk on trade and gold long is actually strange, especially if dollar increases in strength. Commodity prices denoted in US dollar would see weakness. So this is odd that the option flows indicate long gold for Monday. The option flows also indicate long Aussie, pound, yen, Swissy, and gold. So here you have 2 different indications from 2 different market participants for a long gold, and then bearish for London session, Canadian dollar and euro. Potential trade this week, long US dollar versus yen. Why? Bounce expectation. We have been seeing, and these, I know you've been playing this trade for a longer period of time. Every time we hit new lows, the dollar differential, the yield differential versus the DXY bounce was overdue, and it may be that they're using the absence of the dollar players today to bounce it, and then put the Fed potentially guiding towards more aggressive hiking path on Friday. That's a ways off. It's also construction day. On the yen, we have this dovish Bank of Japan, sorry, this is meant to be Bank of Japan governing team reestablished, and we have risk on sentiment in the market right now. So trade structure as a startup position and then 2 levels to add. And then risk for the trade, obviously dollar jawboning from the US administration and or negative risk sentiment, which would then lead to yen inflow. close. Quick look at the chart. So I went long Friday into the close. You saw that the overnight session was used to withdraw some liquidity. We hit this POC and we're bouncing off of it. And I'm just looking at 3 different liquidity levels, hoping to get into this long. Guys, that's it for today. Let me see how many minutes we did. Half an hour. Thank you for your patience. Jens, I apologize for these issues this morning. I hope that's okay. And this week, hopefully we'll be able to make a little bit of money. And hopefully you saw from last week's trade that if you hit liquidity levels and the market is not bouncing there, that is telling you that the market has some structural strength. In that case, it was euro dollar, which I was looking to short. And despite the numbers, it actually kept going higher into the significant macro level at 125. So always get used to looking at the macro levels and keep an eye on the big picture. Thank you very much. Jens, over to you.
Yeah, thank you too. Great webinar like always. Sorry again for small technical issues, but that is Technik. In Germany we say Technik is Technik. I'm not sure if you can say so in English too, but I guess you understand. Tomorrow is another day. Tomorrow it's Paul's Day. Yeah. 5 days a week, 5 different traders. So tomorrow another day trader with another trading style. If you have time, please join us. Have a good time, a good trades, and greetings from Berlin. Bye-bye.